Good morning. It's Tuesday, September 3rd, 2024. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer here at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly and economic market commentary. The presentation you're about to see and or hear has been prepared by us, Cantor Fitzgerald Investment Advisors. We are an SEC registered investment advisor. It is designed to be used by individual investors and financial advisors, but each are expected to make their own investment decisions. Nothing in the presentation should be treated as investment advice, no tax advice, no recommendations for the purchase or sale of any securities. We continue to have a pretty good year, actually an excellent year. When you take a look at some of the numbers here, the S&P 500 approaching 20% year to date, and it's just the beginning of September. Small and mid-cap stocks have lagged far behind, as they have for much of the last, say, 5 years, but still very positive, very attractive returns. I'd take 8 or 12% anytime. Emerging markets, international markets, all up last week. Not big movement last week. Remember, we had those NVIDIA earnings, and said they would be the main driver of the markets. They were just okay. They were actually excellent, but just okay relative to expectations. So the market didn't move a whole lot. Fixed income markets also all positive for the year. We know that interest rates have essentially come down in anticipation of a Fed rate cut this month. This month is Fed meeting, and alternative indices doing what they should do, which is providing absolute return regardless of the directionality of traditional equity or fixed income benchmarks or indices. Let's get into the economic data last week, talk about it. First of all, durable goods orders shot up, kind of like they shot up after we came out of the COVID lockdowns. But when you look through that 9.9% gain, there was some massive defense-related aircraft spending that boosted that number. If you take that out, take out the transportation component, durable goods orders actually fell 0.2%. Capital goods fell 0.1%. So while it was a big number, you can see we get big numbers followed by drops or drops followed by big numbers all the time. It's a volatile data metric, so no big deal there. We started to get, we got a number of items: S&P Case-Shiller Home Price Index, FHFA House Price Index last week for the month of June, fell 0.1%. That's sort of welcome relief, but housing prices via FHFA are still up 5%, 5.1% on a year-over-year basis. That helps our balance sheets for those of us that already own homes, and that helps consumer spending because of that net worth, that feeling of value of the balance sheet effect. And we got similar data from S&P Case-Shiller. They said that their home price index gained 0.4% and is up about 6.5% year over year. But we talk about housing and inflation all the time because the Fed, the whole country wants to see core PCE inflation come down. They want to see CPI inflation come down and PPI inflation come down. And in fact, the Fed has this mandate from Congress. Unfortunately, Congress doesn't have a mandate, so they can deficit spend, which is quite inflationary, and it crowds out the private sector as well. They can do that. They don't have a statutory mandate not to create inflation. So they, under the law, the way it's written, they can kind of do what they want. And then they look to the Fed to try to fix the problem created by large amounts of deficit spending. This graph shows the CPI owner's equivalent rent component. And owner's equivalent rent is taking, maybe you, like me, you've been in your house for 22 or 23 years, and your mortgage payment that you have left for another 7 or 8 years doesn't reflect what it would take to rent that place. And that is a very big component of the overall CPI. It's in the neighborhood of 24 to 28% of the major CPI. Now, you can see from over 8% a couple of years ago, 2 years ago, we're down to roughly 5.1 or 5.2%. The average since 1994, 30-year average, is about 3%, but the Fed's inflation target is 2%. So for me, it's difficult to say the Fed should be cutting interest rates in September. And I get they need to be ahead of it. It's like driving a ship and there's no brakes and you have to start your turn and back off the throttles far before you want to make that turn. I understand all of that. But this number is still way, way, way above the 30-year average. Now, again, if you're like me and you've been in your house 22 or 23 years, okay, you're not as affected by rising rents. But if you're like a large percentage of the population that is young and hasn't purchased your home yet, or your first home yet, or you're not young and you just don't own a home yet, or haven't owned a home, you're getting hurt the most by the inflationary policies. Taking this and taking a look at core PCE inflation, another data metric that we got last week. In July, core PCE prices were up 0.2%, and they're up 2.5% from a year ago. Remember, the Fed's target is down here at 2%. So we're still well above the Fed's target. Why is this inflationary number coming down more than the CPI inflation number? Because the core PCE number puts a much lower weighting on shelter. They say it's about 15% of what we spend money on. Now, respondents to the CPI survey say it's about 25, 26% of what they spend money on. Think about your own situation. Is housing, shelter, is that 20% of your monthly spend? Is it 15? Is it 10? Is it 28? Is it 30? It's different for every individual. But here we are, right ahead of a Fed meeting coming later this month, September 18th. The Fed is widely expected to cut interest rates to get ahead of a perceived softening of the labor market because they have a dual mandate: price stability, i.e. inflation and deflation, and full employment. We are at full employment. We have very low weekly claims for unemployment, but they're trying to get ahead of that. They're thinking about cutting rates. I had said 3 months ago they won't, because the data doesn't suggest that they should. The data still doesn't suggest that they should, but the market believes wholeheartedly that they will. And it seems likely that they will, based on Jay Powell's speech at Jackson Hole, based on some of the other voting members' speeches as well. So this graph shows you what the futures market is suggesting the Fed funds rates will be as measured on the left. And you can see they're expecting it to be below the current level 5.25, 5.5. So it'd be 5 to 5.25 at the September meeting, right there. And really by the end of, let's call it next year, the end of 2025, we're expected to be down to 3%. And that implies a certain number of hikes or cuts. A hike or a cut is defined as 25 basis points in either direction, not the act of hiking or cutting. So while I don't think they should, they probably will. And that means inflationary pressure remains higher for longer. If you've owned your home for 23 years, your mortgage payment isn't going up, but maybe the price of other things will. And if you're trying to get into the home, get your first home, it becomes further and further out of reach as you spend more and more on rent while you wait and try to save for that down payment on that home. We got data from the Conference Board. Their consumer confidence number for the month of August actually rose a little bit from 101.9 to 103.3. Well, does that mean the economy is softening? Well, confidence is already below what it was, largely knocked down by inflation. And we have seen a little bit of relief at the gasoline pump. But people said their present situation's up a little bit. Their expectations are up a little bit. But they are concerned about jobs. So not to say the job market is absolutely perfect and as good as it was a year ago. But we then, the next day, got initial claims for unemployment. I've always said below 300,000 is the sign of a very strong labor market. Jobs are plentiful. Weekly jobless claims came in at 231. Really not much off the bottom here, which we've been between 200 and call it 240, 250 here ever since we came out of the COVID-related lockdowns. Continuing claims for unemployment still well below 2 million. So taking preemptive action on the jobs market before the job is done with the inflation picture could prove to be a difficult decision or maybe even the wrong decision down the road. We got second quarter GDP number. It was originally reported at 2.8. It got revised higher to 3%. 3% GDP in the world's largest economy. This is real. This is not nominal GDP, real meaning adjusted for inflation. So even after inflation of 2.5 or 3%, the economy grew 3, which means 6% on a nominal basis. The estimate was for 2.8. It beat estimates. Well, when I get that GDP report, I always want to look. There's components: consumption, capital investment, government spending, exports minus imports. Those are the four components, export minus import being one. And the most important, there's two most important to measure the success of the economy is consumption and investment, capital expenditures of businesses. Consumption was revised higher, significantly higher, 2.3 to 2.9. So why do we need to cut interest rates? And why do it at the last meeting right before an election, a presidential and congressional election? Why not wait till November 5th, 2 days after the election? Pending home sales fell 5.5%, the lowest level of homes for sale or in contract but not sold or closed yet on record. And they're down about 4.6% from a year later. Why? Simply put, rates are high. They're waiting for the cut. They expect the cut. Why put a home under contract when if you wait 30 days, interest rates are likely to be lower, or 60 days or 90 days? So that if you're in that industry, you're certainly very negatively impacted by the rate hikes of the last couple of years, and you'd be positively impacted by the cuts that are expected to come later this month. Speaking of personal income, back to that GDP report, but we got another report for the month of July. Personal income was up 0.3%. Personal spending was up 0.5%. Hardly seems like we're near entering recession to the point where we need to cut interest rates all of a sudden. Admittedly, they're a little higher than neutral, but they need to be higher than neutral because that's the way you bring down the inflation rate. The other way you could do it would be to curtail deficit spending and curtail excessive regulation on things like energy. But the Congress isn't willing to do that. Sometimes the Fed has to act even when they don't have the sharpest tools in their toolbox. Back to sentiment again. I mentioned Conference Board. We also got University of Michigan. It rose here a little bit, still well below pre-COVID shutdowns and all that. Consumer sentiment rose from 66.4 to 67.9 in August. Current conditions fell a little bit. Now we're pretty much through earnings season. We don't have any major earnings reports coming out this week, but we do have a fair amount of economic data. We didn't have any yesterday, Monday. It was Labor Day, of course. This morning, the S&P Global's domestic manufacturing PMI expected to be below 50. The people that are arguing for the rate cuts are really looking at manufacturing and saying, hey, look, it's below 50. It's contracting. We need to get ahead of this. Remember, manufacturing is 15% of the U.S. economy. It should be more. I get it. It's important. I get it. But the services is about 85%, and those PMIs you'll see down here Thursday, 55, well above 50, showing significant expansion. We've got construction spending as well. We've got the July trade deficit, which is subtraction from GDP. Job openings, 8.1 million. 8.1 million open jobs. That far exceeds the number of unemployed. Factory orders. The Beige Book will come out on Wednesday. That's the sort of the board book of all the regional Fed banks that gets compiled for them to read and digest ahead of their actual FOMC meeting. Annualized auto sales for the month of August, weekly claims expected to be 225. Then we are in a new month. This is September, so we're going to get the big jobs reports from ADP. They say we're going to have 145,000 new jobs. We're going to get some productivity and labor cost data. I mentioned the services and then the ISM, both above 50. And then on Friday, the big one, the Bureau of Labor Statistics jobs report, expected to add 165,000 jobs. And unemployment actually expected to tick down from 4.3 to 4.2. Again, if unemployment's ticking down, why do we need to cut interest rates? Average hourly earnings expected to be up 0.3%. Thanks for tuning in on the YouTube channel and seeing the graphs and charts and me. But don't forget, if you're driving or something, and you could also just listen in on any of the different podcast formats by saying to your smart device, please play Herb Morgan's podcast, or please play Slaying Bulls and Bears, making the complex and complicated simple and sensible. Thank you. Back to you again in 1 week.